TSS and BTE have joined forces.
Context.
Power.
Edge.
The new paradigm of trading.
You know, when you break your arm, the x-ray shows this really clean, jagged white line.
Right.
And the doctor just points to the film and says, there it is. There's the problem. And I feel like we expect that exact same kind of clean, binary precision from a market sell-off.
We do. We really do.
Like a bad earnings report comes out, a stock drops, and everyone can just point to the exact paragraph in the press release. We crave that simple narrative, right? Cause and effect. But last week,
the X-ray machine completely broke.
Completely. Hello, TSS traders. We've prepared a summary of the past week for you. Because stepping into the world of systemic market unwinds, especially ones driven by geopolitical shocks and just massive derivatives positioning, it requires a totally different diagnostic toolkit.
It absolutely does. The landscape we're looking at right now is, frankly, it's murky. I mean, we spent the week of March 23rd to March 27th, 2026, navigating a market that was entirely decoupled from traditional fundamentals.
Yeah, decoupled is the word.
Right. The price action just wasn't being driven by corporate earnings or, standard supply and demand mechanics for the underlying stocks. It was being driven entirely by the plumbing.
The plumbing.
Yeah, the complex, often completely hidden interactions between macro catalysts, dealer hedging requirements, and these massive volatility structures.
Okay, let's unpack this. Because we are looking at the entire narrative arc of what has to be one of the most volatile, technically fascinating, and honestly dangerous weeks in recent memory.
Oh, for sure.
It started on Monday with these intense geopolitical sparks in the Middle East, specifically escalating tensions with Iran, and it ended in just a massive Friday capitulation. I mean, the S&P 500 officially dropped down into the 6,300s.
Which is a huge structural shift.
Massive. And while that happened, major indices like the QQQ and IWM plunged straight into 10% correction territory. So our mission today for you, the listener, is to look completely under the hood.
Exactly. We aren't here to just recite the news headlines. You can get that anywhere.
Right. We're here to dissect the options market, the volatility term structures, and that critical dealer positioning to understand the actual mechanical why behind the breakdown.
And understanding that why, that is literally the only way you can navigate the incredibly fragile liquidity paradigm we're operating in right now.
So true.
So to build this framework, we really have to look at how a news headline actually transmits into market mechanics. On Monday, March 23rd, the geopolitical catalyst hits the wire. Tensions with Iran had violently escalated over the weekend, and crude oil immediately pushes higher.
Right. It was approaching that critical $100 a barrel mark.
Exactly. But then, right before the market opened, President Trump tweeted that he was issuing a 5-day delay on strikes against Iranian energy infrastructure.
Which instantly caused the market to completely whipsaw. We saw these violent, short-lived, I think there were 2 to 3% intraday rallies on the S&P 500.
Yeah, they're massive rips.
But underneath that surface-level relief, the options pricing showed the tension remained incredibly high. And I just want to be really clear for the listener here. We are treating these presidential tweets and international conflicts strictly as mathematical inputs.
Pure data.
Right. The market doesn't have a political party. It doesn't have an ethical stance. It has a profit motive. So we are impartially observing how algorithmic and human traders are pricing these specific events into the derivatives market in real time.
That neutrality is so essential because the market was digesting a very specific transmission mechanism, and the spot gamma notes laid this pipeline out perfectly.
They really did.
The domino effect basically works like this. Higher oil leads to higher U.S. rates. Higher U.S. rates lead to lower equity values. And lower equity values lead to higher equity volatility. That chain reaction is basically the defining macro structure of the entire week.
Okay, let's drill into the math of that pipeline for a second. Because when crude oil spikes toward $100 due to Middle East supply fears, it instantly re-anchors inflation expectations higher across the board, right?
Instantly. The bond market reacts violently.
Exactly. The bond market is hypersensitive to inflation eroding real yields. So we saw the 10-year yield push to 4.45% on Monday, which is what, an 8-month high?
Yeah, an 8-month high. And when the risk-free rate spikes that aggressively, the discount rate applied to future corporate earnings has to expand. It forces equity multiples to just contract mechanically.
Mechanical multiple contraction.
Yeah.
But mechanically, what's happening underneath is a massive repricing of risk across all asset classes.
Right. But that final domino you mentioned, the higher equity volatility, that's where the hidden mechanics really take over the steering wheel. Spot Gamma flagged this critical dynamic involving credit traders acting as, quote, forced buyers.
Oh, this is fascinating.
It is. To understand this, you really have to look at the capital structure of corporations. Equity is the absolute bottom rung of the ladder. If there's a bankruptcy or a default scenario, equity gets wiped out completely before the debt holders take even a penny of a haircut.
Okay, right. So put yourself in the shoes of a credit trader. You're managing this massive portfolio of corporate debt and credit default swaps, and you see the 10-year yield rocket to 4.45%.
You start sweating.
Exactly. You know corporate default risks are suddenly rising. You're basically staring at the ghost of those blue owl credit problems from just a few weeks ago, knowing that higher rates mathematically exacerbate refinancing risks.
Exactly. And the massive problem these credit managers face is that hedging a corporate bond portfolio directly in the credit markets is slow, it's illiquid, and it is incredibly expensive.
Because the bid-ask spreads in high-yield debt during a panic are just absolutely brutal.
Brutal. You can't get out. So what do? They cross over into the highly liquid S&P 500 options market to hedge. They become these completely price-agnostic buyers of SPX index puts.
Wow.
They aren't looking for a bargain. Their risk models dictate that they must hedge immediately to protect their portfolios against a systemic credit event.
It's like buying flood insurance after the water is already in your basement, just because your mortgage lender is forcing you to.
That's exactly what it is.
Which totally reframes the entire flow of the market. I mean, it means the massive influx of put buying, which drove that super spike in the VIX on Monday. It wasn't just retail panic or standard equity fund hedging.
Not at all.
It was a structural contagion from the illiquid credit market, bleeding directly into the highly liquid equity volatility space.
Yes. They have the mandate to buy at the absolute top of the options market, regardless of cost. And this really brings us to the most vital data point of the early week. Spot Gamma noted that oil's correlation with U.S. rates turned to a pure one-to-one relationship.
One-to-one.
Right. Crude at $100 a barrel wasn't just some psychological round number. It literally became the absolute O-shot T-line for the systemic unwinding of equities, while sub $90 was the only all clear.
So with that macro trigger established, we really have to look at the options positioning that was just waiting to catch this falling knife. Because early in the week, the spot gamma models flagged deep negative gamma from the 7,000 level all the way down to 6,000 on the S&P 500.
It's a massive zone.
Right. They were effectively mapping 6,000 as the worst-case structural floor. But, and I need to push back on that floor concept for a second.
Go for it.
If the market was plunged into a deep negative gamma state on Monday, meaning market makers are positioned where they have to mechanically sell underlying futures as the market falls, which accelerates the velocity of the move, why didn't the S&P just immediately flush straight down to 6,000 on Monday?
It's a great question.
I mean, if the credit guys were blindly buying puts and dealers were short gamma, why did the market hold up for basically 4 days?
Because the data takes that a step further by revealing the massive gravitational pull of institutional options positions. The market didn't flush on Monday specifically because of the March 31st JP Morgan hedged equity collar.
The JPM collar.
Right. This is an immense systematic options position that gets rolled every single quarter. And for this specific expiration, the put strike of that collar was anchored right at the 6,475 level.
So we have tens of thousands of contracts, billions of dollars in notional value, concentrated at a single strike price. But how does that actually stop a negative gamma avalanche?
It acts as an enormous gravity well. The market makers on the other side of that JPM collar are essentially short those puts, which means they are long delta.
Okay.
As the S&P 500 drops towards 6,475, their positive delta exposure increases. So to remain delta neutral, those market makers are mechanically forced to actually buy the underlying S&P 500 futures as the price approaches 6,475.
Oh, wow. So their hedging creates a floor.
Exactly. This concentrated mechanical buying pressure creates a massive synthetic floor. So for most of the week, despite all the geopolitical heat and oil pushing higher, that 6,475 level acted as a trampoline.
For trampoline, that's a great visual.
The market would dip, hit that gravity well of dealer hedging, and just violently bounce back up.
Which created a highly specific, very tactical trading environment. I know Spot Gamma pointed out that because the credit funds were blindly buying puts at literally any cost, downside protection became astronomically expensive.
Yeah, put skew was pushed to historic extreme.
Right, but that meant Upside volatility was left incredibly cheap. So they suggested you look at short-dated, 2 days to expiration, broken wing call flies as a way to trade this range.
And structuring a broken wing call fly in this specific volatility regime is honestly brilliant.
Walk us through why.
Well, because upside calls were so depressed, you could construct a spread, basically buying a near-the-money call, selling 2 further out-of-the-money calls to finance it, and buying 1 even further out call to cap your risk for essentially a net credit or zero cost.
Right, because the market is pricing in exactly zero probability of a massive rally.
Exactly.
But if that Trump tweet delaying military action hits the wire, and you get a violent 2% short covering rally straight into the 6,700 or 6,800 resistance zones, those cheap call flies undergo massive multiple expansion.
Huge expansion. You aren't taking a heavy directional bet. You are literally exploiting the mispricing in the volatility skew that was caused by systemic panic.
If we connect this to the bigger picture, you are trading the structure, not the news.
Exactly. But, and this is a massive but, for that trampoline at 6,475 to actually hold, the market heavily relies on intraday liquidity to absorb those shocks. And this is where the diagnostic X-ray really started showing microfractures.
Yeah, it got ugly fast.
On Monday, Citi issued a really stark warning in the notes. 0 day to expiration, or 0 DTE, options volume had dropped to a 1-year low. It only made up 57% of total SPX volume.
That is wild. Because if the JP Morgan collar is the safety net, 0 DTE liquidity is the shock absorber. I mean, I view 0 DTE liquidity as a total fair weather friend.
Oh, absolutely.
Right, when the market is just grinding up slowly, 0 DTE traders are there providing massive intraday liquidity. They're selling premium, they're keeping the daily ranges incredibly tight. But the absolute second real trouble starts, your fair weather friend completely ghosts you.
They're gone.
Why does that volume vanish exactly when the market needs that liquidity the most?
Because of a structural shift in how institutions manage tail risk, 0 DTE options expire at the 4:00 p.m. close. They are excellent for hedging a morning CPI print or farming some intraday mean reversion.
Sure.
But during a geopolitical crisis, the primary risk isn't what happens at 2:00 p.m. on a Tuesday. The risk is what happens over the upcoming weekend when the markets are closed and Israel or Iran decide to make a military move. You cannot hedge weekend gap risk with an option that expires today.
Right, you just can't. So the massive institutional capital entirely abandons the 0-day space and moves further out the duration curve. They start buying options expiring in a week, a month, or even a quarter out.
Precisely. And as that capital leaves the 0-day space, the intraday liquidity buffer evaporates. The market loses its daily friction. And when you combine a lack of intraday 0 DTE liquidity with a broader negative gamma environment, the air pockets between bids and asks become massive.
We saw the absolute limit of that transient liquidity on Tuesday when we look at the higher row flow analysis. And for the listener, higher row, which stands for hedging implied risk operations, it measures the real-time intraday delta flow from options trades.
Right. It tracks exactly what the market makers are forced to do.
Exactly. On Tuesday, the market held up, and higher row registered a massive positive $5 billion net delta day. But the notes showed this wasn't investors stepping in to eagerly buy the dip in underlying stocks. It was driven entirely by $4.4 billion in 0 DTE put selling.
The mechanics of that are so fascinating.
Explain that.
Basically, retail and institutional yield farmers looked at the elevated implied volatility on Tuesday and decided to aggressively fade the panic. They sold 0 DTE puts to collect the highly inflated premium.
Right.
Now, when they sell a put, the dealer on the other side is buying that put. A long put position gives the dealer negative delta. To neutralize that immediate risk, the dealer is forced to immediately buy positive delta in the S&P 500 futures market.
Okay, so let me get this straight. That $4.4 billion of put selling forced dealers to mechanically buy billions of dollars of futures, which provided synthetic stability around the 6,550 level.
Yes.
But because these were 0-day options, that support literally expired at 4:00 p.m. It's just a daily mirage. It resets completely to zero the very next morning.
Which leaves the market entirely exposed to the underlying macro current. I mean, Wednesday looked like the calm before the storm. The S&P ground up to 6,592. Oil pulled back a bit to $91. And the VIX dropped 6% down to 25.32.
Yeah, there were rumors of a 1-month peace deal circulating.
Right. But Thursday morning was what the spot gamma notes accurately described as spooky.
Here's where it gets really interesting. because Thursday pre-market futures are down slightly, just slightly.
Okay.
But the VIX suddenly jumps 2 full points and crude oil jumps 3 points without any obvious immediate breaking news headline crossing the terminal.
Nothing obvious at all.
And the notes highlighted that the entire VIX term structure, the pricing of volatility across all future expiration dates, shifted in a parallel move higher. Now, I have to play the skeptic here for a second.
Please do.
The notes mention that realized volatility, the actual historical movement of the S&P 500 over the prior month, was only running at about 13%. The market had barely been moving on a closing basis.
True.
So why are institutions willingly paying massive premiums for a VIX priced at 30 when the actual market is only moving at a 13% pace? Are they just mathematically forcing a drawdown by paying these premiums, or is it pure paranoia?
It looks irrational if you treat volatility as a lagging indicator. But you have to remember, implied volatility is entirely forward-looking. It is the options market's collective pricing of future variance.
Future variant.
Right. When the VIX trades at 30 while realized volatility is anchored way down at 13%, the options market is sniffing out immense tail risk. It means institutional participants have absolute conviction that the current calm is artificial and a violent repricing is imminent.
Wow. It's basically the financial equivalent of the ocean receding dramatically just before a tsunami hits.
That's a perfect analogy.
Like, the water looks incredibly calm, but the physics dictate that a massive wave is already in motion.
And to validate that, Spot Gamma pulled historical data from 1990 to the present. They found that whenever the VIX crosses above that 30 threshold, the subsequent 5-day realized volatility historically jumps to over 24%.
Over 24%.
Yeah. The market was bracing for the S&P 500 to, in their exact words, earn its implied volatility. The tension between the high options pricing and the low actual stock movement was about to snap. The underlying index literally had to accelerate its movement downward to justify the exorbitant cost of those puts.
Earn its implied volet. That phrase gives me chills. The market demands a reversion to the mean, but in the most violent way possible. And that brings us to the Friday capitulation, where the dam completely broke.
It just shattered.
Crude oil surged and decisively breached that critical $100 mark. The transmission mechanism engaged at full throttle. The S&P 500 crashed 1.67% to close at 6,369. The tech-heavy QQQ and small-cap IWM sliced straight into 10% plus correction territory.
Total carnage.
And the VIX. The VIX surged 13% to close at 31, and the VVIX, the volatility of the VIX, which is a pure measure of options market panic, it hit 133.
And the velocity of that drop was staggering because the structural support we tracked all week finally failed. The market sliced right through that 6,475 JP Morgan collar support level like it wasn't even there.
The gravity well wasn't enough to contain the macro selling pressure.
Exactly. And the higher data mapped the exact anatomy of that failure. Unlike Tuesday's positive flow, Friday registered a massive negative $5 billion in net delta.
And the composition of that delta is what really matters here. It wasn't zero DTE flow. It was driven primarily by $4 billion in longer-dated put buying. The chart showed the slope of this put buying steepening aggressively right after 12:00 p.m. Eastern Time.
Right at noon.
That reframes the entire afternoon flow. It means the 12 p.m. acceleration wasn't a new geopolitical catalyst hitting the wire. It was a pure dealer hedging threshold being breached.
Spot on. That 12:00 p.m. acceleration is the absolute textbook signature of dealer convexity taking over. We really need to break down the mechanics of convexity for the listener because it is the engine of a modern market crash.
Break it down.
Convexity means the rate of change is accelerating. When institutions bought $4 billion of longer-dated puts, they bought them from market makers who were instantly forced into a massive short gamma position.
And being short gamma means your directional risk exposure changes dynamically and unfavorably as the market moves.
Yeah, yes, exactly. As the S&P 500 falls, the market makers' short put positions become exponentially more sensitive to price changes. Their negative delta exposure expands rapidly.
Okay, I'm with you.
So to avoid catastrophic losses, these dealers are forced to dynamically hedge by shorting the underlying S&P 500 futures, but their shorting pushes the market even lower.
Which further increases their negative delta.
Exactly. Which forces them to short even more futures.
It creates a self-fulfilling mechanical feedback loop. The dealers are just blindly selling into a falling market, completely blind to valuations or company fundamentals. They're strictly following the hedging math.
Just math. And this feedback loop obliterated the 6,475 support. The free fall only finally arrested right before the close when the market slammed into the 6,300 level.
Why 6,300? Why did it start there?
Spot Gamma's gamma heat maps showed that 6,300 was the only remaining pocket of positive gamma. There was a dense concentration of short puts down there, likely institutional, cash-secured puts that provided just enough mechanical friction to finally pause the avalanche.
Wow. But the structural damage to the market's plumbing was already profound at that point.
Oh, absolutely profound.
I mean, the founder's notes on Friday morning, right before the open, literally stated, this is the type of stuff major crashes are made of.
They weren't exaggerating.
No. They recounted the historical context, looking at previous events where the VIX spiked past 60. They cited the August 2024 carry trade unwind, the April 2025 tariff tantrum, the March 2020 COVID crash, and even the 2008 Great Financial Crisis.
The big ones.
The notes explicitly warned that the current combination of negative gamma, transient zero DTE liquidity, and geopolitical catalysts driving oil and rates shares identical DNA with those historic unwinds.
And when the underlying liquidity structures vanish and you are left entirely at the mercy of mechanical dealer hedging, the magnitudes of the drawdowns become historical. But what's fascinating here is that while the broader index was experiencing this systemic heart attack, there was incredible divergence happening under the hood.
Yes. Let's transition to that, because the Mag 7 anomaly on Wednesday blew my mind.
It was so strange.
We just detailed the VIX surging and SPY implied volatility exploding. But while the broad market was utterly terrified, the implied volatility ranks for the magnificent 7 single stocks names like Tesla, Nvidia, Palantir, Apple, Amazon were historically low.
Incredibly low.
Palantir had a one-year 4 rank of just 6%. Tesla was at 14%. Why is the options market pricing in a tsunami for the S&P 500 while simultaneously pricing in a gentle breeze for the most historically volatile tech stocks on Earth?
It comes down to the psychological and structural shift in how institutions deploy their hedging capital during a macro crisis. The spot gamma data summarized it with one brutal phrase: no one wants calls.
No one wants calls.
Right, because the market was hyper-focused on systemic tail risk. The Middle East, crude oil, interest rates, all the institutional capital flowed heavily into broad index puts. If you are a macro fund manager terrified of a weekend escalation, you don't hedge by buying a put specifically on Apple.
Right, that would be inefficient.
Exactly. You buy SPX puts to blanket hedge your entire portfolio.
So the capital flight into index downside means single stock upside calls are completely abandoned. The demand just evaporated, so the implied volatility on those calls plummeted. They were left on the clearance rack.
Which created a massive contrarian opportunity. Spot Gamma was actively looking to get long one-month calls in these Mag 7 names.
That feels risky, but go on.
The structural logic is completely sound. Think about it. If the geopolitical situation stabilizes even slightly, the fear premium drains out of the index puts. The broad market snap rallies via dealer short covering, and those deeply discounted Mag 7 calls experience massive IV expansion as traders rush back into single stock risk.
Oh, I see.
You're buying the exact convexity the rest of the market has currently discarded.
It's the ultimate asymmetric setup. Moving to another incredible single stock flow, let's talk about gold, ticker GLD.
Oh, the gold trade.
Yeah, gold saw massive swings, dropping 12% early in the week. Now, that feels counterintuitive for a traditional safe haven during a geopolitical crisis.
It does, but it was likely driven by the spiking 10-year yield making non-yielding gold mathematically less attractive.
Right, the yield competition. But on Tuesday, Spot Gamma flagged a monster print. An entity came in and bought massive institutional put protection on GLD. But they didn't buy puts for next week or next month. They bought the January 2028 410 puts.
Yes, almost 2 years out.
What is the mechanical logic of going that far out on the duration curve during a highly localized panic?
Well, a trade of that duration is a structural macroeconomic hedge. It's likely from a sovereign wealth entity or a massive global macro fund. When you buy deep in the money puts that far out in time, you are locking in a guaranteed floor for an immense physical gold portfolio while actively managing your vega risk.
Vega risk.
Yeah, your exposure to implied volatility changes. By going out to 2028, you avoid paying the hyperinflated near-term volatility premiums associated with the current news cycle.
Ah, clever.
You are taking a multi-year view on the macroeconomic cycle, hedging against long-term fiat or rate dynamics rather than a weekend headline. And ironically, shortly after that massive APS put purchase, gold bounced strongly off its 400 put wall to close the week at 415.
Wow. The smart money laid down their structural hedge, right at the local bottom.
Right at the bottom.
That is an entirely different weight class of trading. On the other end of the spectrum, the sheer stubbornness of GameStop, ticker GME, was honestly hilarious.
It really was.
The macro environment is collapsing, rates are spiking, oil is at $100. GME reports earnings on Tuesday. Their revenue declines by 14%. The options market is pricing in a massive 6% implied move for the stock.
And what happened?
The stock barely budges. It just sits there, pinned exactly, literally to the penny, at its $21 put wall.
GME is a masterclass in options market mechanics, completely overriding fundamental reality. The stock is historically incredibly gamma sensitive. The positioning had created such a massive concentration of open interest at that $21 strike that it acted as an impenetrable gravity well.
There's that term again.
Yeah. The market makers were gamma scalping back and forth around that $21 level so aggressively that their hedging flow completely suffocated the fundamental news of a 14% revenue decline. The options tail completely wagged the fundamental dog.
And we saw a similarly bizarre tape on Friday with Micron, ticker MU.
Oh, Friday was wild for Micron.
It's Friday afternoon. Macro dam's broken. The S&P is dropping nearly 2%. The NASDAQ is getting hammered. And Micron closes the day in the green.
In the green on a crash day.
Right. Spot Gamma observed traders aggressively selling the May 350 short puts, collecting $13 million in premium. How does $13 million in premium collection actually stop a stock from falling during a systemic macro crash?
It is the power of targeted, localized volatility selling. Even in a massive macro unwind, large institutional players will identify a specific valuation level on a specific stock that they fundamentally want to own. By selling massive amounts of the May 350 downside puts, they're executing an institutional cash-secured put strategy. They're basically saying to the market, we will gladly buy Micron at $350, and we will take your $13 million to make that promise.
Wow.
Now, when they sell those puts, dealers buy them, right?
Right.
Which creates negative delta for the dealers. So to hedge, the dealers must immediately buy millions of dollars of Micron stock. That localized dealer buying acts as a powerful buoy, keeping Micron green while the broader tech sector completely sank under macro pressure.
It literally proves that even when the broad market is experiencing a systemic flush, there are highly specific mechanical battles happening at key strike prices right under the surface.
Exactly.
So what does this all mean? We have covered an incredible amount of granular mechanical ground today. For the TSS traders listening, the summary of this past week is basically a masterclass in market plumbing.
It really is.
We watched how a geopolitical spark transmits through the master key of crude oil, crossing $100, forcing U.S. interest rates to spike to 8-month highs. We saw how those high rates threaten illiquid credit portfolios, forcing credit managers to cross over and become price-agnostic buyers of equity puts.
The forced buyers.
Right. We watched the transient fair-weather liquidity of the 0DTE market completely vanish as capital moved out the duration curve to hedge weekend risk. And finally, we tracked how deep negative gamma positioning forced dealers into a mechanical shorting feedback loop, accelerating the Friday capitulation and slicing right through that massive JP Morgan 6,475 support collar.
The actionable lesson for you, the TSS trader, is the absolute necessity of recognizing these cross-asset warning signs before the capitulation occurs.
Before it happens.
Right. You cannot wait for the S&P 500 to drop 2% to realize you are in a convexity trap. When you see the VIX rising simultaneously with crude oil and the entire VIX term structure shifting higher while the S&P 500 is completely quiet and range-bound, that is the options market mathematically sounding the alarm.
The tsunami is coming.
Exactly. Furthermore, effective hedging in this paradigm isn't about just blindly buying puts when put skew is in the 90th percentile. The smartest defensive play is often recognizing when upside volatility is historically cheap and using structures like broken wing call flies to finance your positioning and exploit headline-driven relief rallies.
You have to trade the mathematical structure that is presented to you, not the fundamental narrative you wish you had.
Absolutely. And I want to leave you with a final thought to really mull over.
Let's hear it.
We have spent this deep dive analyzing the mechanics of a single week. But zoom out for a second. We keep seeing these violent mechanical flash crashes and sudden VIX explosions happening with increasing frequency.
Yeah, it feels like it's happening all the time now.
We navigated the carry trade unwind of August 2024. We survived the tariff tantrum of April 2025. And now we have mapped the geopolitical gamma unwind of March 2026. If the market's complete reliance on derivatives, massive algorithmic hedging, and transient short-dated options has permanently altered the nature of systemic liquidity. It raises an existential question.
Which is?
Is the traditional buy-and-hold investing strategy effectively dead? Has it been permanently replaced by a market structure where you must actively trade volatility and understand dealer gamma positioning just to survive the drawdowns?
Wow. If the plumbing is permanently wired for these explosive convexity-driven crashes, you can't just close your eyes and hold anymore. You have to learn how to be a plumber.
You really do.
To all the TSS traders listening, thank you for diving deep with us into the mechanics today. It was an intense week, but understanding the underlying why is the only way to navigate the chaos. Have a great weekend, stay safe, and we will see you on the next deep dive.